You know what's wild? People will spend hours researching the next hot stock while carrying credit card debt that's quietly charging them 20% interest in the background. That's like trying to win a race with the parking brake on. Everybody wants to talk about investing. Nobody wants to talk about the order you should handle your money in first. And honestly, that order changes everything. Because building wealth isn't just about how much money you invest. It's about where each dollar goes first. Most people completely mess this up. They jump into crypto, options trading, meme stocks, and trendy ETFs before they even have basic financial stability. Then one emergency hits and the entire plan collapses overnight. So in this video, I'm going to walk you through the smartest order to invest your money step by step. The same framework financially successful people quietly follow while everyone else chases shortcuts. And trust me, some of these steps are probably not what you expect, especially the part about why paying off debt can outperform investing and why one of the most powerful accounts in America is something most people barely even use. Let's start with the thing people love ignoring, your emergency fund. I know, it's boring. Nobody clicks on YouTube videos hoping to hear about savings accounts. But this is the financial foundation everything else sits on. Without emergency savings, every unexpected expense becomes a disaster. Car breaks down, credit card, medical bill, credit card, lose your job, panic mode. And the worst part is that people often end up selling investments at the exact wrong time just to survive financially. That's why your first goal isn't investing, it's stability. Forget the idea that you instantly need 6 months of expenses saved. That number scares people into doing nothing. Start smaller. Your first target should simply be your first $1,000. That amount alone can prevent most financial emergencies from turning into debt. Then aim for 1 month of living expenses, then 3 months. And if your income is unpredictable or you work freelance, you may want even more. What's interesting is that people with emergency savings tend to make better financial decisions overall because they stop operating from fear all the time. Money decisions made in panic are almost always bad ones. Now, once you've got that safety net in place, the next step becomes extremely important. High interest debt. And when I say high interest debt, I'm mainly talking about credit cards. Because credit card interest is brutal. If your card charges 22% interest, that means your debt is growing faster than most investments realistically will. So when someone says, "Should I invest while carrying credit card debt?" the answer is usually no, because paying off that debt is basically a guaranteed return. Think about it this way. If you eliminate debt charging 22%, it's mathematically similar to earning a guaranteed 22% investment return. You don't get many guaranteed returns like that in life. So before trying to become an investing genius, stop the financial bleeding first. Now, there's one huge exception to this rule, and it's something people ignore way too often: employer matching. If your company offers a retirement match, you should almost always contribute enough to get the full match, even if you still have debt. Why? Because employer matching is basically free money. If your employer matches 50% of your contributions up to a certain amount, that's an instant return the moment you invest. No stock market strategy on earth guarantees that kind of return overnight. So the smart move is simple. Contribute enough to get the full match. Then focus aggressively on eliminating high interest debt. Once the debt is gone, that's when things get really interesting. Because now you enter the tax advantage stage of wealth building. This is where wealthy people quietly save enormous amounts of money over time, and most average investors completely overlook it. The first stop here is usually an IRA. Why? Because IRAs often give you more investment options and lower fees than employer retirement plans. A lot of workplace 401ks are packed with expensive mutual funds that slowly eat away at your returns year after year. The difference between high fees and low fees might sound tiny, but over 30 years that difference can become tens or even hundreds of thousands of dollars. That's the power of compounding working against you instead of for you. Now, this is also where people start asking the big question, traditional or Roth? Do you pay taxes now or later? Traditional accounts reduce your taxes today, but you pay taxes when you withdraw the money later in retirement. Roth accounts work the opposite way. You pay taxes up front, but your future withdrawals can be completely tax-free. And honestly, there's no perfect answer for everybody. If you expect your income to rise significantly over time, Roth accounts can make a lot of sense while you're younger. If you're already in your highest earning years, traditional accounts may provide better tax savings today. A lot of smart investors actually use both. That creates flexibility later in retirement when taxes become a giant puzzle. Now, here's the account almost nobody talks about enough. The HSA health savings accounts are ridiculously powerful if you qualify for one. In fact, they may be the single most tax-efficient investment account available. Here's why. You get a tax deduction when you contribute, your investments grow tax-free, and withdrawals for medical expenses are also tax-free. That's 3 separate tax advantages in one account. Most retirement accounts only give you 1 or 2. And here's the strategy wealthy investors quietly use. Instead of spending HSA money today, they let it stay invested for decades. Meanwhile, they pay medical expenses out of pocket and save the receipts. Years later, they can reimburse themselves tax-free while the investments have had decades to compound. It's honestly one of the smartest long-term wealth-building tools most people completely overlook. After maximizing accounts like IRAs and HSAs, then you return to fully maxing out your employer retirement plan. At this point, your money is working extremely efficiently. You're reducing taxes, capturing employer matches, avoiding high interest debt, and allowing compounding to do the heavy lifting. Now, finally, this is the step most people want to start with immediately. Taxable investing accounts. This is where you can buy individual stocks, ETFs, index funds, crypto, or basically anything else. And yes, these accounts are incredibly flexible, but they're also less tax efficient. Dividends can be taxed, capital gains can be taxed, and frequent trading creates even more tax friction. That's why taxable investing should usually come after maximizing tax-advantaged accounts first, not before. But once you reach this stage, you've officially built a very strong financial foundation. And that's the key difference between people who slowly build real wealth and people who constantly feel financially stressed no matter how much they earn. So let's simplify the entire sequence. Step 1, build an emergency fund. Step 2, eliminate high interest debt. Step 3, capture your employer match. Step 4, maximize tax-advantaged accounts like IRAs and HSAs. Step 5, fully fund retirement accounts. And finally, build wealth further through taxable investments. That's the order. Not flashy, not exciting, but incredibly effective. Because wealth usually isn't built through financial tricks. It's built through smart systems repeated consistently for years, and the people who understand that early end up miles ahead of everyone chasing shortcuts.